Welcome to The Explainer. Today, we're diving into something that can be a secret weapon or a major roadblock when you're buying a home: child support. So can child support actually help you buy a home, or could it hurt your chances? It's a huge question for a lot of people out there, and honestly, the role it plays in getting a mortgage is way more powerful than you might think. We're talking about something that can literally make or break your home loan application. And here's why it's such a big deal. It truly is a financial double-edged sword, right? If you're receiving child support, lenders can see it as a powerful source of income, which means you could qualify for a bigger loan. But if you're the one paying it, well, that's a monthly debt that eats into your borrowing power, and it can seriously shrink what you can afford. Okay, so here's how we're going to tackle this. First, we'll look at how child support can work for you as income. Then we'll flip the coin and see how it works against you as debt. We'll also cover the really serious topic of what happens when you're behind on payments. And finally, we'll put it all together into a mortgage action plan for you.
All right, let's jump right in. Section 2, using child support as income. We're going to look at how the payments you receive can actually boost your qualifying power.
Okay, so the first big hurdle you've got to clear is proving a consistent history of payments. Lenders need to know that money is stable and reliable. And, the rules for how you prove that, they can change dramatically depending on the exact type of loan you're going for. And this is where things get really, really specific. Check out this table. You've got FHA loans, which are pretty flexible. They only need to see 3 months of history for court-ordered support. But then you look all the way over at Fannie Mae. Totally different story. They are super strict. They want 6 full months of perfect, on-time payments with absolutely no averaging allowed, no wiggle room at all. Okay, but it gets even better. Some programs have this secret weapon called the gross-up. Now think about it. Child support income is tax-free, right? So what some lenders do is they basically calculate what that income would be if you had to pay taxes on it, and they use that higher number to qualify you. It's a huge advantage. And this right here is a total game changer, especially with USDA loans. They can gross up your child support income by a whopping 20%. So let's say you get $1,000 a month. For qualification purposes, the lender can count that as $1,200. That is a massive, massive boost to your borrowing power. All right, so now we have to flip the coin. Let's talk about child support as debt. If you're the one making the payments, this is a whole different ballgame, and the rules are just as important to understand. So the rules here basically split into 2 clear camps. On one side, you've got FHA and USDA loans. For them, it's simple. They will always count your child support payments in your monthly debt calculations, period. But on the other side, VA and Fannie Mae, they actually give you a potential break. They'll only count it as debt if you have 10 or more months of payments left to make. And listen, if you're aiming for an FHA loan, you have got to pay attention to this. This is critical. They don't just look at what the court order says you should pay. If your wages are being garnished for a higher amount, guess what? They're going to use that higher number. And that one little detail can totally blow up your debt-to-income ratio and get your application denied. Okay, now we need to talk about the most serious issue of all. What happens when you fall behind on payments? Because when it comes to government-backed loans, this isn't just a problem, it's an automatic disqualification. Here's why. If you're delinquent on court-ordered child support, your name gets flagged in a federal database called CAIVRS. You can think of it like a federal blacklist for people who owe money to the government. And if your name pops up on this list, it's a hard stop. It's an automatic denial for any government-backed loan, like FHA, VA, and USDA. And as you can see here, the impact is immediate and severe for those government loans. A CAVRS hit means you are flat out ineligible. It's a non-starter. Now, for a conventional loan, like one from Fannie Mae, it's handled a bit differently. There's no CAVRs reporting, but a delinquency can still pop up as a judgment on your credit report, which can absolutely derail your application just as effectively. But, and this is important, there is good news. Getting flagged in CAIVRS doesn't have to be a life sentence. There is a clear pathway to get back on track. First, you have to get a formal court-approved repayment agreement. Step 2, you have to prove you can stick to it by making several consecutive on-time payments. And once you've done that, you can work with the state agency to get that flag removed from the system. So we've gone through how it works as income, how it works as debt, and what happens if you're delinquent. Now let's bring this all home and build your personal mortgage action plan. So let's boil it all down.
The key takeaway here is that child support is a major, major factor. If you're receiving it, it's a huge opportunity. If you're paying it, it's a reality you have to plan for. And if you're behind, that's a real danger zone for government loans. Remember that every program is different. FHA is great for speed, but USDA gives you that incredible income boost. And the most important thing, you've got to have a loan officer who gets all of this. It is absolutely essential.
Okay, so here are your action steps. This is your checklist before you even think about applying. 1. Gather all your documents, the court orders, bank statements, the whole shebang. Get it ready now. 2. Calculate your debt-to-income ratio, with your child support included, whether it's income or debt. 3. If you are behind, you need to start that resolution process right away. Don't wait. After that, you can strategically match a loan program to your situation. And finally, find a lender who is an expert in these specific rules. And there you have it. You now understand the entire landscape, the good, the bad, and the complicated. So the real question is, which one of these loan programs is the right fit for your journey? Now you have the knowledge to look at FHA, VA, USDA, and conventional loans and confidently decide which path is going to be the best one for your unique financial situation. You're ready.